Okay. So, good evening, students. I welcome you all to the second guest lecture of Auditing and Assurance Services course, your course, auditing course. Today's session is also conducted by Mr. Damit Gamage from Ernst and Young. You already know him because he conducted last week guest session as well. So, welcome, sir, and thank you very much for joining for the second session as well. So over to you, sir.
Thank you, Natasha. So, good evening, everyone. For the better connectivity purpose, I'll switch on my video. But as much as if you can make it interactive, feel free to ask questions and any clarity, because these two areas that have been selected today for this auditing lecture are very important aspects, even though sometimes we touch this on a nitty-gritty basis. It is very important, or rather in a rare circumstances, this will be required. So feel free to ask any questions. No question is a stupid question. Feel free to ask any clarity if you need in terms of these areas. So basically, like Natasha explained, so these are related to auditing lectures. So we are not teaching any accounting standard aspects here, especially with related to the related parties. But how do we handle that in the case of audit is the topic that we're going to cover today. So we are covering two topics today within next couple of hours. The first one is about the auditing going concern. Second thing is about the auditing related parties. So let me start first with going concern. So these are the lesson objectives. So basically, we are planning to cover today the going concern assumption in preparation of financial statements. So we are going to start with that, why this is important and where this is related to in our day-to-day life. And once it comes to the going concern, if there are any issues, how to identify these going concern indicators is the second one. And the management's responsibility in addressing this going concern, and in terms of auditors. So what is auditors' responsibility in addressing this? And addressing these audit responsibilities, what procedures auditors can do. And finally, the implications that can have to the audit report from the going concern. So those are the broader topics that we're going to cover today. Basically, nothing very critical, but once it comes to this point number two, we're identifying these going concern indicators. And after that, if the indicators exist, how to handle that in the audit is the one fundamental thing that you need to keep in your mind. Sometimes uh, we miss this particular aspect of going concern. Why? When we're doing the audits, we do find a lot of audit errors, accounting entries, the differences with the schedules and non-compliance with accounting standards and stuff like that. And in most of the cases, we pass some double entries and correct these accounting errors. But going concern is not something like that. It has been embedded with the qualitative and quantitative aspects of the company and the financial statements. So either you address it or not, financial statements won't change sometimes. So because of that reason, we would miss addressing these going concern implications in financial statements. So that's why it is very important to know that. So let's see the going concern assumption in preparation of financial statements. What do you mean by that? So going concern is one of the fundamental assumptions when we use in preparation of financial statements. So basically, you'd have definitely seen financial statements where assets and liabilities are classified under non-current and current. So non-current assets, non-current liabilities, so things like the balances like that. What does that mean? The company would last long for a foreseeable future. That is why we think some of these assets and liabilities will crystallize or will realize after even a 12 months. So under this going concern principle, financial statements are prepared on the assumption that entity is a going concern. So entity, in simple terms, entity has the ability to move forward without an issue. So that is what we call going concern, and will continue its operation for a foreseeable future. So this foreseeable future, it is, I mean, known or can be defined as more than 12 months period, right? So in terms of our auditing aspect or the rule that we follow in our firm, so this 12 months should start counting from the date of the audit opinion. So we say it's a 31st March company and 31st May is the audit opinion date. So we see whether company can survive, basically whether company can survive from this 31st May 2025 until 31st May 2026 minimum. I mean, it's a minimum. If the company can survive, so more than 12 months from the date of the audit opinion, so then we see company, or we presume the going concern assumption is appropriate in preparation of these financial statements. So keep that in mind. It's very critical. As I said, financial statements are not wrong in terms of the numbers, but if there are going concern issues, then it has other repercussions, which I will explain. The balance sheet per se will not change, right? So when the going concern basis of accounting is appropriate, assets and liabilities are recorded on the basis that the entity will be able to realize the assets and discharge its liabilities in the normal course of the business. So if the going concern assumption is valid, so then the assets and liabilities are arranged in the realization basis or the discharge basis once it comes to the liabilities. So if the going concern basis is not appropriate, what happens? Then the financial statements are prepared on another basis, such as liquidation basis, or using the liquidation basis, it's likely results in non-current assets and liabilities being classified as current assets and current liabilities. Example, if we believe company does not have going concern, so it means, I mean, from today in next 12 months, or company can't operate beyond 12 months from today. So then is there any point we showing anything on non-current? Because as a fact, we know company is not a going concern. So then what happens is, so all the balances should be classified as current assets and current liabilities and rearrange on a liquidation basis. So we've seen if the companies are, I mean, example, if the management has decided to liquidate the company, so no more operations. So they are going to hand over or they have decided by a board minute to hand over this company to a liquidator for liquidation purposes. In such a scenario, is there any point we showing non-current? No. So the financial statements are then prepared on other than going concern basis, right? So that is a fundamental rule. Two options: either you presume company is a going concern and prepare financial statement thinking that the company will have the going concern because no indicators. So then your assets and liabilities, depending on the maturity, will have non-current balances also. And you will disclose the fact that the going concern assumption has been used in preparation of these financial statements. Otherwise, what happens? There is no going concern basis. So then assets and liabilities are uh, rearranged by taking away the non-current pieces or classifying the non-current assets and liabilities to current. So those are the two fundamental avenues anyone would have if the going concern basis is there or not. Now, the theoretical part. How do we identify whether company is having an issue of going concern? Have you seen companies like that? How do we know? By looking at, will the company board of directors voluntarily come and say, look here, we do not have going concern? Could be situations like that as well, but might not be the case always. So that's why we need to find what these indicators are in terms of the going concern to identify whether this particular company is bleeding or not in terms of the going concern. There are many indicators that we can use. Some are quantitative, some are qualitative, but merely, this is a caveat, this particular indication analysis and concluding the company is having a going concern indicator or an issue need a lot of professional judgment. So need a lot of consultation, need a lot of professional judgment, because just merely seeing one of these indicators, that does not mean the company is having going concern indicators. But sometimes having one indicator also could lead to a going concern issue. One or combination of these indicators would indicate that the company is having an issue with the going concern. So, when to understand whether the company is having a going concern indicator or an issue, all these can be used to as a checklist or a tick box exercise to see where the company stands at as of the balance sheet date. So let's see what these are. Of course, the profitability matrices, gross margins, EBITDA, net income, whether those are negative. So if the company is having a loss, if the gross margin is a loss, if the EBITDA is a loss, yes, then it shows a red alarm, red light. The company would be facing some issues. The second item, net not generating sufficient cash through operations, or that the entity does not have the financing necessary to invest in its business. Now, you'd have seen, if you have seen a cash flow statement, there is a line item called net operating cash. So if this operating cash is negative, what does that mean? What does that mean? Company does not have money to spend to their day-to-day operations. It's like our lives. Like if you do not have money, we say we do not have money to spend to buy our lunch packet, to go in the bus. So what happens then? We can't run our operations, right? So once it comes to a company has so many financial commitments to pay to salaries, to get the raw materials, or pay to the machinery, so what not, right? So if this operating cash flow is negative, it's one sign, and that aggravates a problem. If you see the financing part of the cash flow, company does not have any financing facilities also. So then the problem is severe. One hand, company operating cash flows are negative. The other hand, no arranged financing facilities also. Again, if you relate it to your life, if you do not have money to run your day-to-day operations, what would you do? You'll borrow money from someone. So that is called this financing activity. Now, in this case, you don't have money, neither you have anyone to borrow. So then can we live? Is a question mark. So it's the similar way to the company also, right? So some other examples also, or the indicators, and there are significant inventory items. So we say it's a manufacturing entity. Of course, we know then debtors and inventory balances are significant in terms of manufacturing. But out of your total inventory, a major portion is obsolete. The company can't sell, even with a lot of efforts, company can't sell this inventory to a third party. So they are manufactured, incur a lot of cost. Due to whatever reason, the inventory is obsolete. So then what happens? This particular inventory balance will not convert to a working capital or to a cash. Then to meet the financial liabilities, company, even though company does have assets. So there, that is a tricky point. Like you see, company do have assets. Then one can on surface see, look here, inventory is there. I'm sure the liabilities can be paid by realizing this inventory. But when you go deep, you understood, okay, inventory is obsolete. Now what are we going to do? It will never be converted to cash. It will have a very nominal scrap value, if at all, or a zero value. So then even though you have an asset, you don't have realizability of that particular asset to pay your liabilities. Again, a going concern indicator. So, like inventory, as I said, the receivables is also very critical. So, even though we show these receivables as a receivable balance in the balance sheet, but there is no collectibility of these particular debtors. We know for sure debtors will not pay. So, if the debtors do not pay, we don't have cash to run the operations. Then one of the other indicators, so recognition of, so renegotiation the loans or related guarantees that involves taking on unplanned increases in debt or arrangements that increase interest rates. So if the debt is required to be restructured, say example, in situations where when you borrow from a bank, there are loan covenants being stipulated by the banks. So if these loan covenants are breached, so then in most of the loan agreements, it says loan has to be repaid on demand if the covenants are not being met. So in such a case, what happens is, so company has to pay on demand in the sense the entire non-current portion ideally should be classified under a current liability, and company should have cash to pay that. So if any such situation happens and if the bank is very tough with the company, so then again the company can go bankrupt, because if the banks are demanding for a 5-year loan, we say the balance part of the loan can be paid over 5 years, but because of all these issues, bank is asking money back immediately. So the entire 5-year loan, it has to be repaid now itself. So things like that, if those has happened. And all these revolving loan facilities are not being given by the bank, and any other adverse key financial ratio. So it's a good habit. I mean, as financial professionals, if you all can work out some of these critical ratios like liquidity ratio, net working capital, debt to equity ratio, things like that, and see how the financials have been moved and whether there are any red lights being given out of these ratios. And also, we have seen some of these companies do have a lot of gearing. I'm sure you would have heard that word, gearing. So once it comes to the compared with the equity, the debt is very high because company has borrowed, and I'm sure you'd have heard situations where the companies have collapsed actually, because what happened there is company borrow long-term borrowings, and and they go and invest in the assets which does not generate adequate cash to repay these liabilities when it is due. We call it assets and liability mismatch could happen. We say company has gone and borrowed. I'm really hypothetical example. Company has gone and taken a long-term loan and gone and invested this particular loan in a property, and that property is a bare land. So now the loan is 5 years. Company is having other difficulties in their operating cash flows. So top of these operating problems, now companies repay this loan also. So which is now due the installments, but this land is not generating any cash. So we'll say again, due to some reasons, they are unable to sell this land also. So the cash is stuck at there, right? So these assets and liabilities have a mismatch. So asset is long term, still the projects that the company thought of starting on this land has not started. So huge mismatch. So then company doesn't know how to bridge this working capital requirement and this asset and liability mismatch, right? So those also could stuck the company financially, which could badly affects the company financial statements, and in turn it would be a going concern issue. And any non-compliance with laws and regulations, because certain rules are very strict, and if a regulator thought, okay, company or the regulator will not renew the license of this particular company, However, how much your financial statements are very strong and you have cash and all that, the regulator, I mean, in certain business, you all know a regulatory reason is a must to run the company, to operate the company. So for whatever non-compliance reasons, the regulator is not giving uh, the license or not renewing the license or suspending the license. So however, how much your financial statements are strong, then you have a going concern issue because you can't operate without this license. And net current liability positions, because those are also one of the indicators. What do you mean by this net current liability position? So you have current assets, you have current liabilities, but the current liabilities are far excessive than current assets. So what does that mean? You have like 100 rupee to pay within next 12 months, but you have only assets worth of 50. You have cash worth of 50 or cash or some other assets which can be converted to cash, only 50. So how do you pay the balance part of 50? Then you have to go and borrow again. So then borrowing has a finance cost. So it's a spiral effect or a cascading impact, rolling impact would be there, uh, because you are continuously borrowing. And after some time, banks will not give borrowings also. So that there only the deadlock would come, right? So liquidity problems, sometimes market, I mean, in most of the foreign countries, it is been seen compared to the book value, the net asset value. If the market value is very low, so then that also taken as an indicator, but in Sri Lankan context, it's little different because sometimes these market prices does not very much reflective the performance of the company, because these market prices would vary for due to some other various reasons. But in foreign countries, the performance of a company and a market value go hand in hand. In such a scenario, if the market value is really below the book value, again a concern of the indicator. Uh, and any shareholder disputes, we'll say the shareholders will have an agreement, shareholder agreement, but if the disputes are there, and because of those reasons, the company is not in a good governance, or no one is there to control and operate the significant decisions. And in some cases, there are very successful companies, but I mean, some of these companies are totally people driven. So they depend on their founder, chairman, founder of the company. And once these founders resigned or demise, so no one doesn't know what would be the strategic vision and how to run, how to face a problem. So sometimes the companies or these particular giants would fall with the uh, particular founder, chairman, or the people. So those also kind of problems. Uh, and if there are any problems with the recoverability of some of these assets like goodwill and all that, again will be a problem. So I mean, this list is not exhaustive list, but if you have any questions or the problems if you've seen in a company, especially if you are very critical example like no operating cash and neither a financing facility available, and adverse profitability indicators, huge losses, and any of the non-compliances which are very serious in nature, which could affect to run the company, and excessive gearing, if the debt is very huge, and any other qualitative aspects like loss of supplies or inventory and debtors not being or assets like debtors and inventory not being realizable as a cash. So those are, I mean, 3 to 4 very top indicators of a going concern that I can say that we have seen in companies, which could result going concern issues. So remember, I mean, again, I'm emphasizing that. So when you take a financial statement and when you're analyzing the background of the company by taking the information, I mean, like other day I said, when you do an audit, So you need to see what risk factors are affecting to the company from inside and outside. So I touched all that at my earlier lecture. So this is also one of the factors that you would have factored when we getting the data to see whether going concern indicators are there or not. So basically, keep those in mind. Sometimes it's not directly visible, but you need to do a little bit of homework to see whether going concern is a real issue there or not. Now, example is one of the balance sheets that of a listed company. I mean, these are public data, but I'm not divulging the name of the company. Basically, if you see, if you can concentrate on this retained earning part for half a minute. What do you see there? So this retained earning shows a 51, whatever currency we'll say, billion negative impact. So because of these reasons, the total equity shows a 17 billion negative balance, right? So that shows adverse financial indicators once it comes to the balance sheet. And specifically in practical terms, when we auditing, if a company is having total equity as a negative or as a debit balance in the presentation as a negative balance, definitely we will very strict on going concern. We'll strictly analyze on going concern because there could be a situation where we need to address going concern as auditors. And so whereas if the retained earnings are minus, again is huge indicator that auditors are very serious about if all those financial indicators are negative. Because why this has gone negative? Merely because the company had incurred massive losses in the financial year. So I mean, in simple terms, you would definitely understand if you are making a loss, so then you can't survive. Basically, that is it. So if your outflows are more than your inflows, if your expenses are more than the salary you get, then you'll have to depend on someone by borrowing. And at some point, no one will borrow you. So then what happens? You go bankrupt. So this is a similar life theory that I'm trying to teach you today, right? So company or anyone should have that financial discipline. Uh, I mean, to spend money according to what they have earned. Otherwise, this would be the situation, right? So that's all about the going concern indicators. Now you know when a patient comes as a doctor to identify what the root cause, whether this particular person is sick or not. I'm sure I would have touched all those symptoms of a sick patient as a doctor, that I'm sure you are now vigilant about it, right? So before we come to the auditor's shoes, what is management's responsibility on going concern? Because once it comes to the financial statements, the preparation of these financial statements, the responsibility is with the board of directors and the management. It's not anyone else's responsibility to prepare these financial statements in accordance with financial reporting standards. So in preparing these financial statements, management is responsible for assessing entities' ability to continue as going concern and disclosing as applicable matters related to going concern and using the going concern base of accounting unless the management either intends to liquidate the entity or cease operations or has no realistic alternative but to do so. So what are the few management responsibilities? Let's break into pieces and see. In preparing financial statements, management is responsible for assessing the entity's ability to continue as going concern. So it's management responsibility to assess this entity's ability to continue as going concern. It's no one's responsibility. So when you're doing that assessment part, the management should check all those indicators and see first whether there are any problems. So if the indicators are there, Then what is the remedy for that? Also has to be assessed. For example, if the company is uh, having difficulties in finding cash to run their day-to-day operations. So then what the management should do, quickly they should see what borrowings that they can get and whether the company has any assets to pledge in case if the bank is asking, or to get some funds with a plan, right? So without a plan, if you go and borrow also won't work, because as I said, these assets and liabilities have to be matched. There should be a repayment plan. I'm sure the bank is also will be asking that whether the company has any growth plans or to find new buyers, whatever, right? So assess the entity's ability to continue as going concern. So that is very critical. So after this assessment, what is the way of communicate? The communication method is financial statements. So then what do we need? Disclosures. So disclosing as applicable matters related to going concern. So disclose as applicable matters related to going concern. But we'll assume there is no issue at all. So then company can categorically say management have assessed and blah blah. There is no going concern issue, and the financial statements are prepared based on the going concern assumption. So that's it. But if there are problems, then we need to first briefly explain what the issue is, and the mitigating factors is very critical to be mentioned in the financial statements. The company or the disclosure should not stop at the point only disclosing the problem. Then the users will misled and see, okay, they have a problem, but they don't have any remedy sort of thing, and all the stakeholders will get upset of all. I mean, all the stakeholders will be scared about it, right? Because if the problem won't be disclosed, so this disclosure plays a very critical role there. So how we word matters uh, to reflect the correct position in the financial statements once it comes to this going concern. Because this going concern is actually a very disclosure heavy mechanism, because as I said, it's not merely numbers, it's more uh, qualitative announcement using the numbers is my reading on that, right? So if and that is about the going concern assumption. And top of that, if the company does not have going concern, so then the fact that it is being prepared on liquidity basis and all that need to be disclosed. When making this going concern disclosures, before disclosure, the going concern assessment, management should consider all available information about the future. So all the events after the reporting date, example, we say the company do have a problem in the going concern. So then the company is planning to do a right issue. So all these details, the board approval on the right issue, and how we're going to do the SEC announcement, or whether shareholders are willing to pump money. So things like that. So all this information about the future actions should be there, and it should be accurate. And of course, when we're disclosing some of this information, we need to consider whether these are market sensitive information just to go and put in the annual report. So having all these compliance requirements being met, the fundamental rule is about the future, all these aspects need to be disclosed in the financial statements. However, management do not need to make a detailed analysis, and auditors should not need to carry out detailed procedures if the entity has historical profitable, and if any of those indicators are not existed, this particular exercise is not a lengthy one. So then it's a very simple, uh, a small analysis would do from the management side and the auditor side. But no harm have those checklist of items that I explained in that previous slide in the boxes, and just to tick it off, saying, this is not there, this is not there. Current assets are more than current liabilities, no loan covenant breaches, no non-compliances with key regulations, company is profitable, retained earnings is plus, total equity is a plus. So all these. So if all these boxes are ticked positively, then this analysis is not much of a hassle. So little bit of touching the Companies Act part. It has a direct impact here. Section 219 of the Companies Act, it talks about insolvency of the company and the actions that the director should be taken. And what is the most common scenario is the serious loss of capital situation. We have seen in enough some of these companies are actually facing serious loss of capital situation. So serious loss of capital situation generally may not be always, but generally considered as a going concern indicator of the company, because if the company is having serious loss of capital situation as stipulated in the section 220 of the Companies Act, then company, the management and auditors both should be vigilant whether it's a real going concern issue or not to be concluded. Certainly, working steps are required for both management and the auditors if the serious loss of capital is there in a company as of the balance sheet date. So, very quickly to touch upon what is the serious loss of capital. If the net assets are less than half of the company's stated capital. So, how come the net assets less than half of the stated capital becomes? So it's like this. If the stated capital is 100 rupees, if your net assets is less than 50, in the sense, total equity, stated capital is also a component. So then what had led to there? Why having 100 rupee stated capital, why the net assets is below 50? What had been the reason? Some of these retained profits should have ideally been negative. So we say stated capital is 100, retained earnings is minus 75. Stated capital is 100, retained is minus 75. Then what happens? Total equity is 25. So total equity is less than half of the stated capital. So that shows that negative retained earning is again a red light, an alarm, and being ring on adverse going concern position, or the company would lead to a going concern issue. So for serious loss of capital situation, Companies Act is giving a kind of remedy. The shareholders should be called for an EGM, and the company should give the plan at that EGM how the further losses can be prevented. Because in general, serious loss of capital situation arises because if the company is earning losses. So at the EGM, shareholders should be informed what the management's plan is to accumulate further losses, right? So let's see now as auditors. So I think we covered the going concern, what is going concern indicators, and if the indicators are there, what is management's responsibility to address this issue. Now let's wear auditor shoes. Audit procedures, let's high level see what audit procedures are there when we see events and conditions which cast material uncertainty related to going concern is identified. So the auditing standard reference is SLAS 570. So that deals with the going concern implications in the auditor's report. The auditor's responsibility includes obtain sufficient and appropriate audit evidence regarding the going concern and conclude on the appropriateness of management's use of going concern basis of accounting in the preparation of the financial statements, and conclude based on the audit evidence obtained whether a material uncertainty exists about the entity's ability to continue as going concern. Right. So what does that mean? auditor, in very basic terms, auditor should get sufficient and appropriate evidences to see whether the management has taken the right position on the going concern. So management says, yes, this company is having going concern. So we take the assumption of going concern in preparing the financial statements. So auditor should go and see to get the appropriate uh, appropriate audit evidence, sufficient and appropriate audit evidence to see whether what management says is accurate, or if not, whether the material uncertainty is exist in this going concern assumption being used, right? So basically, auditor has a big role here to get these sufficient and appropriate audit evidences to see. The auditor must remain alert throughout the audit for evidences of events or conditions that may cast significant doubt on the entity's ability to continue going concern. Now, don't think the going concern is something that we can do right at the end of the audit. So that is not a myth. That is a myth. It's not the case. Going concern, to identify whether there's an issue or not, throughout the audit, the auditor should gather the evidences and the information to conclude this particular aspect, because it's not an easy task. As I said, a lot of professional judgments are involved in this particular auditing scenario once it comes to the going concern, because some of these evidences that the management is giving would be very qualitative. So example, my previous example, in one of the recent situations I had, company had a going concern issue, and the management and we were very strict about it. Then the board gave me a resolution saying, okay, we will do a right issue to get the money or to get the additional funds required to the company. And the board has approved, and the board paper is there. And as auditor, okay, it's acceptable kind of, right? Because if the company is having a problem, company doesn't have sufficient funds to run their day-to-day operating cash, and the company is going to get the funds through right issue. Okay, on surface it's fine, but what's wrong with it, right? Why not? I mean, a lot of companies would do that also, to do right issues to get the money. Then, as an auditor, because I knew in this particular company, in previous situations also, the shareholders have given money to these right issues, but still the company has eroded those funds being given in previously also. And top of that, company had not been able to declare a dividend in previous occasions as well. Then in such a situation, it was always in my doubts whether anyone would like to pump again the money for this bleeding entity via right issue. So then I asked, okay, board resolution is fine on the right issue, but get me the consent of top 5 shareholders that you are having at the moment, because right issue, you all know, the right issue can be given for the existing shareholders. So get me a confirmation of getting their consent. They like to pump money to this company. Then only the problem started. They couldn't give, because even though board resolution was there, when they reached actually to get this confirmation, since the auditor requested it, the shareholders refused to pump money for this company, because as I said, the same reasons. They have pumped money in previous occasions, but they have not got any return out of the funds that they invested. So because of that reason, it didn't work for this company. The right issue was not the remedy. Then, long story short, and then it went to very different dimension, and we had to address that in the audit opinion, because the company could not prove the going concern ability. They could not, because of the heavy gearing, they couldn't get any new borrowing facilities also, and the shareholders also didn't want to subscribe to the right issue, and they couldn't find any new shareholder because even though they find a new shareholder, the existing shareholders did not want to dilute their stake because they have invested all these years, haven't got any return. And top of that, to get their share diluted also, they didn't want to. So all these reasons together, company could not prove their ability to continue going concern, especially in very simple terms, they couldn't prove how they can bring new cash to the company because already cash is not adequate to run the day-to-day operations, right? So that is that serious. That's why I said uh, uh, we should not go by surface. We should not merely go by just the board paper because something beyond, we need the clarity and the evidences because this particular matter is very strategic, right? So in most of this planning and risk assessment process, company or the auditors required to check whether this going concern problem because it's not fair on the clients also. I mean, if you are an auditor, it's not fair on clients also. You go this particular aspect right at the end of the audit only because if that is very serious, the auditors will have to qualify the audit opinion or give adverse audit opinion. So from the planning, from the day one itself, if there are any problems like that, you should keep the client informed, not to give surprises because that has a very direct. I mean, if something, if the things are not good, things are not right, there is a serious repercussion to the audit opinion. So some of these mitigating factors, because if there is a going concern problem, it's it's very essential and it's a must to have these uh, mitigating aspects. So especially if there are going concern problems, the main thing as auditors we request is a cash flow forecast prepared by the management for the next 5 years or whatever to see how this, because sometimes this profit or sorry the loss that the company has made in the current financial year could be temporary, could be because of one-off situation. So then we can see how prospective the company's future cash flows. But these future cash flows should be prepared with a lot of diligence. We can't use any aggressive assumptions, wrong assumptions, and just merely to satisfy audit or any other stakeholder have a very lucrative picture in this particular cash flows. The cash flow has to be realistic. An auditor has to check these cash flows, each and every assumptions, judgment, and estimate made in preparing this cash flow. The auditor should audit and satisfy themselves this cash flow is correct. And depending on the cash flow, if the future cash flow has no issue, then that will be very strong mitigating factor, even though going concern indicator is there to mitigate that fact. So those can be used. So top of these future forecasted cash flows, I mean, that is like in any impairment testing, you get the budgeted, the board approved future cash flows. So then you do some of the back testing and see back testing in the sense you compare those futuristic results with the current achievements to see whether these futuristic results are achievable targets or not. So top of these future cash flows, any other restructuring debts or entering new borrowings, new equity infusions like right issues and disposals like if the company is going to dispose any of the assets and to realize those cash. And this fourth bullet point is again one common scenario we have seen. If there are subsidiary companies, if they are financially not strong or if there are going concern indicators, what auditors used to get is a financial commitment support letter from the parent entity. So then parent entity gives a letter directly to auditor confirming if any case, if in any future case, if this particular subsidiary need cash, parent company will intervene and give. So that gives a comfort because that is a good mitigating factor. Provided the parent company also should have the financial ability to give some sort of a guarantee to someone else. If the parent company itself is bleeding, then no point getting a financial guarantee or the financial support letter from that particular poor parent. But if the parent is stronger, so that is a very good mitigating factor for the subsidiary company, or even from a not necessary to be a parent company, but if any shareholder is willing to give such a commitment letter directly addressing to the auditor, that would suffice, right? So in reduce or delay expenditures, a lot of budget curtailments are required. The company should have strict budget to control their expenditure and to increase revenue, like IMF came and did to Sri Lanka, all this restructuring. That's why all these government expenditure being the revenue being increased, these electric tariffs and all that. So, I mean, anyone should learn through the mistakes, because if the company is incurring losses due to heavy expenditure being incurred without any budgetary control, that should be curtailed and controlled properly with the proper budget. So those strategies can be checked at the cash flow forecast that I told earlier also, and the detailed plans to increase the revenue. So those are the mitigating factors that commonly we are seeing. But any other factor, if that is palatable to the auditors, that can be used as the mitigating factors to cover up the going concern issue that the company would have, right? So taking the latest financial statements, the auditors can follow up the procedures with the management, and we can review any other undrawn loan facilities or debentures that can be used as the future financing facilities for the company. And we can read minutes of the shareholders, board of directors, or if any EGMs, extraordinary general meeting, has been called to cover out the serious loss of capital situation which we discussed earlier, and inquire about from the lawyers of the company, and check the prior period events and conditions after the reporting period to see whether any mitigating factors actions have been taken, and the adequacy of the disclosures, and we can get a representation from the management also on all these things. So these are the additional procedures to get to know the going concern issue and the mitigating factors which is required by the auditors, and especially out of all these financial statements reviews, the minute reviews of board and shareholder and whatnot, and the checking all these key legal agreements and the lawyers' letters are very critical to get the correct and a complete understanding about the going concern issue and the mitigating factors. Right? So now, what would happen if there is a going concern issue? Now we have done all these procedures to the extent we can, and we thought we got sufficient and appropriate audit evidence. Now it's a time to conclude what are we going to do with this going concern issue. Okay. If you concentrate to the most right side of the slide, it says the fourth kind of an arrow. No events or conditions identified that may cause significant doubt. So if no issues, there is no implication to the audit opinion, right? So if you see the last light ash color arrow, so determine the implications for audit report is applicable only for the first three boxes. The last box does not have, because no going concern events and conditions. So it's a go through, or it's a pass mark. No modifications required for the audit opinion. So I'm coming from right to left. Then events or conditions identified that may cause significant doubt, right? So then what happens? I mean, if you take the second and third, what is the difference? The second one says material uncertainty exists about the entity ability going concern. So entities management thinks entity has the ability to going concern, but that particular statement has a material uncertainty. The things that they say can happen or not, there is a material uncertainty. වෙන්නත් පුළුවන් නොවෙන්නත් පුළුවන්. There is a material uncertainty in this but exist about the entity's ability to going concern. Right? So the difference in the third one from the second one, you say it's a material uncertainty only. But here, the third one, it says, no, it's a significant doubt. What management say highly unlikely would happen. Right? The first one is again very easy, like fourth one. Company says no going concern. And when the going concern is not there, if the management has prepared the financial statement thinking it's going concern, then it's a huge mismatch. Then definite implication would be there in the audit opinion, right? So let's see the next slide. So what I'm trying to say here, except the fourth point, in the first, all three, you can see the word determine the implications for audit report. Right? In the second and third, disclosures are very, very critical. And first instance, going concern basis is definitely not appropriate. But in the next three instances, going concern basis is appropriate, but going concern basis is appropriate, but in second, it says there's a material uncertainty. Third, it says there's a significant doubt. Right? So let's see how the opinion can be concluded. It's a bit of a complicated chart. I'm not trying to go through all these things, right? So let's see a few okay. So going concern related events. Any events, conditions that may cause significant doubt to entity's ability to continue going concern, no, to your right side. So then there is no modification required. But if it is yes, going concern base of accounting, are we able to obtain sufficient appropriate evidence about the entity's ability to continue as going concern? Are we able to get all the evidences? If it is no, then you go to disclaimer of opinion. Right? If it is yes, then we say whether going concern basis of accounting is appropriate. No, has the management prepared the financial statement using the going concern basis? Yes, then again it's wrong. When there is no going concern is appropriate, if the management has prepared on saying going concern, then it's adverse opinion. Right? Clear? I'm repeating myself. Is the going concern accounting is appropriate? No, but management has prepared using the financial statement as going concern. Then can we opine on that? Management thinks it's a going concern, we think it's not going concern, then it's adverse opinion because there is a disagreement with the management as a whole. So the one before that, the disclaimer is we are not able to get any sufficient and appropriate audit evidence on the going concern. So then it's a scope limitation to us because we are not given adequate access, right? So then again, go to the middle part, going concern base of accounting is appropriate. So then if it is yes, we check whether appropriate, yes, but whether there is a material uncertainty with regard to the particular mitigating factors that the client is saying. Or whether we have evidences. I mean, whether the sufficient and appropriate audit evidence is available for us to conclude. I mean, going concern basis is appropriate, but whether the evidences are sufficient enough. If it is no, then a qualified audit opinion or again a disclaimer depending on the seriousness, because again we have a kind of a scope limitation because we do not have given sufficient and appropriate audit evidences. If it is yes, then what we see whether adequate disclosures have been made in the financial statements. So again, I'm repeating, going concern based accounting is appropriate. We have given adequate audit evidences to check whether there is a material uncertainty, and the FS also been disclosed properly. In such a scenario, there is an unmodified opinion because the going concern problem has been properly mitigated and disclosed also, right? If there is no disclosures, if the company is not willing to make those disclosures due to saying, those are confidential, blah, blah, then again, qualified or adverse opinion have to be made, right? So you can see there are instances where we do give either a disclaimer, adverse or qualified audit opinion. So I'm sure you all know those are the very, very negative reports and one auditor can issue once it comes to these financial statements. So in any of these instances, if the going concern problem is not addressed properly, if the evidence are not given to the auditors, if there is a material uncertainty, and having all these fulfilled, but still if the company has not given proper disclosures, in any of these cases, there is a definite chance for either to get a qualified opinion, adverse opinion, or a disclaimer opinion. So that is the criticality of this particular aspect, as I said. So unlike, if there is a counting error, sometimes we can pass a double entry and correct. But if these qualitative measurements are not appropriate and if the actions be not taken by the directors or disclosures are not being made due to whatever the reason, so then you can see based on these decision trees how impactful adverse your opinion would be. So keep remember this chart. There are a lot of ifs and buts. I will definitely share the slides with your lecturers. Then you'll get that. So this is very critical, right? So keep that in your mind when you come to the going concern. So when we preparing the financial statements, if there is a material, what happens is sometimes company prepares these financial statements and they refer these financial statements or rather the particular going concern note in the financial statements. I'll start with this note first. So now what happens is there's the going concern issue and the management has done everything. Auditor has been satisfied with that. And all these particular mitigating factors are disclosed in the financial statement note, right? So, but of course, these are futuristic actions. Any of these mitigating factors in any company will be futuristic action. So with the futuristic action, it's always there is uncertainty, right? If I say I'll wake up tomorrow morning, it's uncertain. But in this particular case, once it comes to the going concern, we have to see whether there's a material uncertainty. That there is a bit of a more likely chance than not happening. So if there's a material uncertainty, even though we believe all this will happen, yes, we are sure management will do that. But like in any other case in the life theories, there is a material uncertainty. In such case, what happens is, so auditors would emphasize this particular aspect in their audit opinion, saying material uncertainty related to going concern. So it draws the attention. It draws the attention to the sorry about some noise. It draws the attention to the particular note that referred the going concern and all the mitigating actions, the doubt that the company plans would have all these been disclosed in the audit opinion itself. So this is called emphasis of matter in the going concern. So the wording that been used is material uncertainty related to going concern. So unlike in any other emphasis of matter paragraph, in the going concern emphasis paragraph, we categorically use this word material uncertainty related to going concern, right? So in any other emphasis, we call it like emphasis of matter, but going concern has special wording, material uncertainty related to going concern, right? So this is annual report is SoftLogic Holdings PLC annual report 2022-2023, right? So you all can refer that. So this continues the note. I don't want to go through all that because this lengthy note is given once it comes to the going concern. Because a lot of mitigating factors have been given, very comprehensive analysis being given in this particular annual. So recap, when there's a going concern issue, or rather, first of all, we need to understand what you mean by going concern, the going concern assumption in preparing financial statements. Second thing, we need to check whole heap of indicators that is being given and how serious those indicators in case if those are existed. So then we need to get the management to prepare the financial statement based on their analysis and their judgments of going concern. Then throughout the audit from the beginning to the end, auditors should gather data and sufficient and appropriate evidences about the going concern. And the auditor should conclude whether these particular plans, the mitigating plans, the actions that the company is saying that they will fulfill in future to overcome this going concern situation is appropriate or not. So if it is not appropriate, I showed you a decision tree based on each of these scenarios. Either it could be a emphasis of matter paragraph on the going concern, qualified audit opinion, adverse audit opinion, or a disclaimer audit opinion. If everything is happy, only a clean opinion would be coming in. But practical terms, in majority of times, what we have seen, at least the emphasis of matter paragraph would be coming in terms of the going concern of our financial statements. In most of the cases, the emphasis even can be mitigated, like I said, in a subsidiary financial statement scenario. In most of the cases, we've seen parent is giving financial support letter. So if the parent is strong and if the parent is strong giving a financial support letter, then as auditors, we are not much worried because the parent can control the subsidiary and the parent can always intervene and the parent is able financially to intervene. So in such a scenario, only generally, even a mitigating or other emphasis is not being put, but in most of the other cases, I would say 90% times, audit opinion will have some modification. That serious going concern is, if you understood what I'm saying. So that stops me doing the going concern auditing aspect. Happy to take any questions related to going concern now itself, rather waiting until the related party is over because now it's fresh in everyone's mind about the going concern. I'll give 2 minutes if anyone has any questions to raise on going concern only at the moment. As I said, please be interactive. I mean, it's always good for you all to clarify any of the doubts we have because whatever the profession, either auditor or commercial, wherever you go as a finance role or finance figure, going concern is very critical and very important. Okay, looks like no concern. So let's move to the next topic. So the next topic is auditing related party transactions. So related party transactions is something very common in most of the organizations. And if you are in a group situation or due to other reasons, if any of the companies are related party, you do have transactions. Even if you do not have any other related entities, still your key management personnel of your company are related parties. See, in our definition, we do take board of directors as key management personnel in any other entities, but in certain entities, there is a little bit of a deviation there. Some personnel will say there is a chief executive officer who's not a main board director. Still, companies would consider that particular CEO as also a KMP because that particular CEO can govern or direct the company necessary decisions. So I mean, even though what I was trying to say, even though a company would not have any other company as a related entity, still all these key management personnel or the board of directors, in simple terms, would be related parties. So we can't say no transactions. I'm sure any of these directors would pay something for the services that they're giving. So any company, and I mean, there is no company unless the company is really dormant. Generally, a company would have at least a single related party transaction. So, so we see what these related party transactions and why it is so important. The technical references like the accounting standard references, and at the planning and risk assessment stage as auditors, what we should do. And I mean, like I said that day, identifying the risk itself is not enough. We need to respond to the risk, identify risk, what we should do via the audit procedures, how we're going to respond to these risks, and the additional audit procedures with regard to related parties are the session outline for this particular session today. So let's see. So I'm not trying to touch here the accounting standard related to related parties, because as you all know, very simple terms, if you are a company, your parent company, your subsidiaries, associates, joint ventures, fellow subsidiaries, the directors of the company, and any company likewise, there could be many related parties. So what do you mean by related party transactions? The related party transactions refers to the business dealings between two parties who hold a pre-existing relationship. So this relationship, as per the accounting standard, like I said, it could be coming through because of the group structure or because of that they can direct or influence the company. So this can include transactions between an organization and its subsidiaries, affiliates, directors, employees. Such as transactions may not be conducted at arm's length, potentially creating risk for conflicts of interest and financial misrepresentations. So, I mean, it's simple again life theory. With a known party, you can negotiate anything sort of a scenario. So the related party brings the risk to the table for the auditors or to the management or to any other stakeholder, because these related party transactions might not happen at the arm's length basis. Right? So you know the definition of the arm's length. We obtain understanding. I mean, if it is not happened on arm's length basis, so if it is not a kind of a transactions with a lot of transparency and fairness, or as if you have done a transaction with a third party, if you're not conducting the transaction with a related party, so that concludes it's not arm's length, then that's bring a risk to the company, right? So, because of those reasons, we need to pay special attention to these related party transactions, get the understanding about these transactions, because there are increased audit risk and a fraud risk due to the related party influence of these transactions, and whether incomplete disclosures would create any dilemma in the financial statements. So, first of all, before we move to anywhere, when you're doing the audit, the first step we need to do, we should identify what the related parties that this company has. So it's one of the common mistakes that auditors would make. They try to go and straight away audit these related party transactions without understanding what these related parties are, right? So that creates a huge risk of the completeness of the related parties once it comes to the company financial statements. So these related parties, uh, sometimes these companies are being related because of the group structure. We say it's a very massive and a complicated group structure. So then it's very tough sometimes to identify the related parties. So sometimes we say one of the shareholders, or we say an individual controls company A that you're auditing, and he controls a company B, which we don't know, because we say this company B is not getting consolidated to company A at all. It's not within the same group structure. It's not within the same group or whatever. And the particular shareholder has not disclosed also about this company B, because the company B is very much of a his private company, or the company B would belong to his wife, his spouse, right? So things like that. So one of the main risks once it comes to the related party uh, is identifying this related party and the completeness of the related parties. Example, like whether we have identified all the related parties belong to this particular company is the risk that we are running in the first phase once it comes to this particular topic, right? Completeness of the related party. So once the related parties are identified, the second risk is the completeness of these related party transactions. So identifying the party is a problem completely, and the identifying all the transactions without any loophole of the identified related parties is a second challenge. So completeness is a huge dilemma once it comes to these related parties, because people, I mean, unless the company has a robust policies process to capture that, it's a nightmare actually. I mean, I can use that word. It's a nightmare to identify these related party transactions. You know, as per the accounting standards, these related party transactions are required to be adequately and properly disclosed. It's a must. But when you identify these related party transactions, how do we do that if the company does not have a proper process? So example, company A to B, the transactions that went throughout the year, all the revenue transactions, we say company A is generally selling to company B, and the company A is selling to outsiders also. So when you do not record in your ERP systems properly the transactions that went through the company B, then there is no way of identifying these related party transactions disclosures or the other expenditures. So the ERP should have the facility to identify these transactions. So it's auditor's responsibility to first to check that whether company has a proper process and a mechanism to identify these related party transactions. Otherwise, obviously there is a threat. And some companies, right at the end for the financial reporting purpose only, they get the IT to write the queries or various management reports try to be designed right at the end of the audit uh, to identify these related party transactions. So that would be bit of a I don't know how appropriate the completeness of such mechanisms for a company to identify these related party transactions. Uh, Basically, one of the aspects that auditors require to be vigilant for. So the earlier I showed a related party transaction payable and a receivable note. You can see different bases are being used by the companies. So this is subsidiaries and equity accounted investees and the key management personnel, what are the due to and due from. Uh, Small practical hints there. If you can see in this particular company, key management personnel has amount due from 109 million and amounts due to has 1.9 million. So basically in these scenarios, it's not required to give name wise because these key management personnel are related to personnel. There could be definitely directors. So there is no requirement in the accounting standard to disclose this name by. So that's why these been clubbed and shown as key management personnel. So the transactions between company to company, the companies generally give a breakup of the subsidiary, related party due to and due from. So name wise, these being disclosed, right? So this particular company do have loans. So each transaction type wise, they have disclosed these related party transactions, right? So these are the transaction disclosures. Earlier I showed all the balance sheet item disclosures, payables and receivables. Here, these are the transaction disclosures, how much of the sale of goods, rendering of services, acquisition of property, plant and equipment, loans given, loans paid, interest paid. So depending on the high level transactions natures, these being clubbed and disclosed in the financial statements. So basically, it's auditor's duty to audit these balances. So that's why, I mean, if you see in this case, loans given is about 7.4 billion. So auditor should have policies, procedures, and the audit procedures to check the accuracy of these related party loans given within the financial year. So likewise, we can go on. So this particular note is on the compensation to key management personnel. As I said, name-wise is not required. So the short-term employee benefits is the term that is being used in the accounting standard. This includes all the salaries, bonuses, CPF, salaries, bonuses, and things like that. And the post-employment benefits includes when they're retiring, how much being contributed by the company given year through to their EPF and gratuity and ETF and things like that. So these are the disclosures related to uh, amounts being paid to board of directors. So these are public disclosures, right? So basically, technical references, the specific technical reference for accounting is, so the auditing is SLS 550. Sri Lanka Auditing Standard 550 deals with auditor's responsibility relating to related party relationships and transactions in an audit of financial statements. So that is a technical reference. So now you know that, I mean, at the beginning of the presentation itself, why I showed those financial statement notes, then you know the gravity and the gamut of things that you need to audit. Because, I mean, after this presentation, you all can refer a couple of annual reports to see what sort of related party disclosures that the companies would do, companies has done, and what level of aggregations that they have done in terms of the narrations and the balances, and also what sort of qualitative aspects that they have disclosed. And we have seen in many of the financial statements that they are disclosed, these transactions have done on arm's length basis. So things like that being disclosed, it's always good to read annual reports and see, right? So uh, as I said at the very outset, in the planning and risk assessment, now we're going to start the auditing piece of these related party transactions. The first part of this presentation, I covered the related party transactions and the look and feel of the disclosures and how those been processed. So now where are the audit issues? We're going to start auditing this. So first and foremost, at the planning and risk assessment phase, that is the first phase of any of the audit. First, we obtain understanding of related party relationships and transactions through following procedures. So, as I said, it's not easy completely identifying these relationships and the transactions. So, using automated techniques, because what we do in our firm, we get the transaction databases to do the journal entry testing and to do our some of the automated audit procedures. So at that point, one of the things we do from the known related party names, we search the transactions to check the transactions that had gone through and the narrations, and to check the completeness of the transactions that the management has given. So because it's volumes, there is a definite tendency that we miss otherwise, unless we use these type of automated techniques, because which gives the access to the entire database. The second thing, performing inquiries. So the inquiries that we can make from the management itself, we can get, okay, what is the group structure? Whether there are all the cross holdings being updated, whether all the subsidiaries, affiliates, associates, joint ventures being updated. Will in the sense all the sister companies being updated. So, I mean, based on those inquiries, we can get to know a lot of related parties. Uh, and also, we do get declarations from the key management personnel. We call it KMP from the board of directors. We get declarations actually. These declarations gives the details, or that particular declaration is detailed enough asking these questions whether you hold any other shareholdings of any other entities other than what we are auditing. So then this particular director gives the details. Okay, yes, I own company X, Y, Z. So my stake is more than 50%. I control X, Y, Z, and Z. And my spouse is controlling company I and company D. So things like that. So then we know, okay, through his or her declaration, what are the other companies this particular director is controlling at. So then, if the particular director is controlling those companies, automatically it becomes related party in terms of the accounting standards to A2, the company that we are auditing to those entities. So basically, sometimes there is a director, we say this particular director is a director of this company and he doesn't have any shares of the any other company, but he holds a director position of the company B. So there is a person called M, we'll say this Mr. M holds directorship of the company A and directorship of the company B, and he does not have any shares of any of these two entities. So basically what happens, there is no controlling power. Mr. M does not have any controlling power to A or B. He's just a mere director of the A and B. So because of him, would the A and B would be a related party? No. Standard is very clear about that. So this particular, auditing this related party needs end-to-end knowledge of the related party accounting standard. That I would say, without knowing the accounting standard, even though you see entity which could be a related party, would not know that because you don't have the knowledge about the accounting standard. So especially if you are addressing this related party auditing aspect, you should be really thorough with the accounting standards. I'm sure you would have gone through that already. So it's not an issue, but that knowledge is required. And obtaining understanding the entity's process. So this process piece is required, as I said before, to capture these related party transactions, because this completeness of the related party transaction is a huge risk. And sometimes when you're doing a subsidiary audits, your parent company, the group auditors would give you some instructions to give by giving these are the related parties, right? Uh, Especially if there are any related parties who are in a position of dominant influence over the entity's management, uh, then those are actually is a critical part. As I said, because of their share ownerships, they would control some of these entities. So if they're controlling these entities, that would definitely be a related party, right? The second step, whether company has a robust process and controls to identify appropriately the related parties and account those related parties and to extract the disclosures of these related parties, right? Uh, because as you all know, once it comes to the listed entities, they do have a related party review committee. There is a board subcommittee that reviews the related party transactions because uh, regulators require that transactions to be maintained or they're approved properly. Because of those reasons, related party review committee goes through these transactions and maintains. So this particular check whether maintains records related parties that is regularly reviewed and updated, right? So whether these related party transactions are regulated, reviewed, and updated is something that need to be checked. Because in certain instances, we have seen in some of the ERP systems, there's a, I mean, when you key in the data to a particular transaction window, there's a small tick to be ticked if this transaction is related party transactions. So then what happened from this particular tick when they generate a report on the related party transactions, so right at the end of the period, that gives a whole lot of related party transactions as a listing because the ERP has been configured in such manner. So only risk is if a particular operator or the person who's filling the details in the window, if they forget to tick that particular tick mark, so then they would miss or the completeness of these real party transactions would be go missing. So that's why we need to check whether company has a robust process. So establish a review and approval protocol of related party transactions. So sometimes if it is then and there approved, sometimes most of the heads of the departments know, okay, these transactions went through, but it has not captured to this process. Definitely, the party review process must be there, and those has to be reported to the board of directors. So ideally, the good practice is all the related party transactions submitted to the board for their approvals, ideally before execution or at least for the information purpose, those should be submitted. And out of that, the board of directors should definitely review the material related party transactions. And company should have a policy manual that stipulates what should be the related party transactions, process of approving these transactions, and whether the company has a policy that carves out the requirements of the accounting standards to maintain this related parties adequately. Because the company policy of identifying related parties can't deviate from the accounting standard. So accounting standard is very clear what to be related party and what not to be related party. So because of that, those policies and procedures should be intact for company, right? So some of the additional documents that we can peruse in identifying these real party transactions is bank and legal confirmations obtained, minutes of the shareholder meeting. So in any case, like I said previously in my previous lesson, also identifying the events and conditions or identify the going concern or identify the related party. In any of these cases, this shareholder meetings and any other meeting minutes is really critical because these meeting minutes would give triggers to identify any of these transactions or any other documents that the auditor would think necessary in identifying these related party transactions. So those things need to be perused properly to check these related party transactions. Here the main aim, like I said at the very outset, here the challenge is to completely identify these related parties and related party transactions. So that's why we need to do all these to check, because small miss can challenge the completeness of these parties and the transactions there, right? So the first, what I explained are the generic procedures that we can do. The second thing is very specific procedures, making inquiries from the management about the nature of such transactions. So business rationale, terms and conditions, whether the agreements are there, whether related parties are involved. So here, as a best practice, ideally, even if it is related party transaction, ideally the benchmark situation, always it's better to have an agreement between the two related parties to show the transparency and the arms of the transaction. Basically, we say company A is doing selling goods to company B, or company A has given a temporary loan to company B. In any of these cases, it's always the best thing have a related party agreement between the two parties that shows the real transparency and the arm's length of this transaction, and no conflicts. Even in the loan agreement, that could say the loan has been given at the market rate, as if this company B has obtained that loan from an outside bank. still the repayment terms, so no ambiguity there. So then it's very clear cut, right? So we inspect the underlying contract or agreement. So that is very critical. So in case if you do not see such a transparency, then you need to address that as a, I would say, as a control breach to the management, and you should insist to have those agreements ready with the management going forward, at least to see the transparency of the transactions. And whether it has any complex terms, unusual terms, uh, and if that has any other, I would say, illogical nature or reasons, whether it contains unusual matters. So all those need to be perused when we're doing these contract reviews. So at a minimum, there must be a memo of these transactions be reviewed, because of course there is a susceptibility of fraudulent transactions that can happen. So example, company can, we'll say company A is not achieving the targets. So what they would do, company B, they get the company B hold. Okay, please buy these items temporary. They just put an invoice to company B. I'm invoicing you. Uh, and all these revenue transactions are being recorded in the company A, and subsequent to the year end, company B again return these goods to company A. So doing this exercise with a normal third party customer is not that easy, but having A and B are related parties or known forums, or sometimes the main shareholder might do that thing due to some other reasons, whatever the reason. So this particular related party transaction, I mean, related party is someone flexible. If you want to create a bogus revenue entry, there you easily use this company B as a mechanism to pass this transaction, right? So those type of risk are associated with this relay party. Because relay party is known to be a little flexible than any other mechanism to execute these transactions. So that's why we say susceptibility of this related party or the happening is susceptibility of a fraud happening with a related party is very high, right? Uh, So in case, because ideally a company should make a disclosure in the related party notes that they have done this transaction on arm's length basis, we need to go and substantiate this particular wording, right? So we can't just ignore that saying, okay, company says that is arm's length, so why we worry it? No, it has a very, very significant bearing. Because if it is not arm's length basis, then the company should disclose those facts, and the additional disclosures are required in such a scenario. But if the company is disclosing these transactions are arm's length basis, then we need to go and check, okay, take a one particular sales contract with this related party and see whether it is the same price that the company A has sold to company B, which is a related party of them, opposed to the price that the company A has told to company Z, which is not a related party. If it is the same price, okay, company can say it has done on arm's length basis. If that is a critical term or something complicated, we can engage a specialist to see whether this transaction is like that, or we can use sometimes industry norms, uh, or we can say how the company's computations, how that pricing has been arrived, or any other internal or external data that suppose this particular disclaimer or rather statement saying the transactions has done on arm's length basis. I'm re-emphasizing, if you see this particular thing disclosed in any other financial statements, you cannot just ignore it and say, oh, it's just a very qualitative statement, why we are required to be bothered, because it's not the case. Then you have to substantiate it, whether it's actually a arm's length transactions or not. by doing all these procedures I explained just now. uh, don't take it very light, right? Because the stakeholders think, okay, if auditors also have audited that, then the management says this is on arm's length basis. Yes, it would have done on arm's length basis, no jugglery or no undercutting that. But if the reality is different, then it's a very serious issue. So on those areas also we can obtain the written representation from the management. And also, like I said before, from the key management person, we get the confirmations generally. So this confirmation consists of what they have. I mean, this is a confirmation that we are generally obtaining key management personnel, the compensation that they are paid, information and other transactions that they have carried out. Uh, I mean, it should address to the firm and all that. The designation of the person, right? Signature, and how much would be salary and all that. Director fees that they have obtained. So all those information could be obtained, right? So what terminal benefits that they have got, and what insurance premiums that they have given, or any other benefits. So like that, we get a declaration from the key management personnel on their transactions. And top of these transactions, we can get the confirmations from them pertaining to the number of shares that they are, or the entities that they're holding a stake in any other organization. Uh, and because of those reasons, whether they have influence for those companies, whether they control those companies because of that. Because, like I said, unless that particular director declares it, we don't know whether they hold any other companies, because there could be companies that they have gone and invested. Or, I mean, if you all know, I'm sure you all know accounting standard better. So it's not only them; their spouses, and it goes on. There are dependent children, all that could come in. So if any of those, if they've gone and invested in some of these companies, those becomes automatically related parties, spouse equivalent. So it's so complicated. So that is why there can't help. It's a inherent limitations from auditor's point of view also, uh, because we don't know if they don't declare. Sometimes we don't know. Based on the share registers and minute books, we can go and check. And with our previous knowledge, sometimes here one of the other things, we can brainstorm our knowledge also about the related parties, or about these companies, about the directors, because sometimes there could be senior audit professionals who knows about this particular entity or the person and all that, right? So all these techniques being used to identify these related party transactions. So like I said, the fraud risk is very high. As I said, if the company is not achieving the revenue targets, I think if you remember my last lecture, I covered what are the requirements to be fulfilled to a fraud. We'll say this company has a revenue target which they want to fulfill, uh, uh, which they want to fulfill to get the bonus or year-end incentive or whatever you call it. So then they are short. So then they quickly call to a related party that they generally are selling. Look here, you buy from me and return it later on as at the year end. Because sometimes it's a related party. They use they share the common workspaces, or the common. I mean, they would be friendly because of the same wing. It's everyone works in the same group of companies, so a lot of relationships are there. So that's why the fraud risk is very high. Any other related party transaction, especially if there are any spikes at the revenues or any unusual transactions that have gone through with these related parties, should be definitely considered as a risk, and real substance of the transactions required to be audited by the auditors. It could be sales, purchases, or loans, or anything to that nature, right? So I don't want to re-emphasize again and again the risk that is there. And the second thing, identification of these related parties. Sometimes they execute, but conveniently omitting disclosing these related parties. They know it's very sensitive information sometimes if this goes to the market. So, but as auditors, we need to check, we need to be vigilant the transaction. Sometimes simple things when we auditing the bank reconciliations, we say we auditing the unpresented checks. So when we auditing that list of unpresented checks, we see related party list, the transaction that the company had done with these related parties as unpresented check. A check has been raised for company B, which is a related party. Okay, so then we tick that as we tag that as a related party transactions. When we auditing related party transactions, we use that knowledge. So if there are many team members in the audit, at the very outset, at the very beginning of the audit, there must be discussion with the entire team members and should give them the knowledge about what are the related parties of this company. Okay, what is the group structure, percentage holdings, who are the directors, who are the KMPs. So then throughout the audit, when they see any transactions while they carrying out the audit procedures for any other area, okay, they'll note that okay, we saw a related party transaction like that. So sometimes we enter that into Excel and keep or get a cross check while we are in the related party section whether these at least the known related party transactions that we saw elsewhere being disclosed in the financial statements. So we can use some practical tips like that when you're auditing these related party transactions. I mean, once it comes to the audits, may not be every audit related party is a significant balance, but especially when you're auditing a group audit scenario, it would be a very significant matter. And that has a direct impact to the taxation also, because if you all have heard of transfer pricing rules and regulations, directly affecting to these related party transactions. If there are any violations of these related party transactions, that would have a definite impact uh, to the uh, transfer pricing, the non-compliances of the transfer pricing regulations as well. So basically, having said all these reasons, you all understand related party, how important these related party transactions are to the financial statements. Uh, and this accounting standard is also little goes to the nitty-gritty levels, but you should be thorough with the accounting standard requirement, then not to miss these related party transactions. So apart from the risk associated with these related party transactions, once it comes to the auditing, so the identification of the related party and the related party transaction, the completeness are the two basic challenges. But other than that, nothing very specific. It is also again another balance that we need to audit, like we do the vouching, call confirmations for the outstanding balance, get the declarations from these key management personnel. So procedures like that would cover the sufficient and appropriate audit evidence with related to these related parties. Uh, we have seen related party transactions. Again, this opening to closing ideally should be reconciled in your work papers, because if there's a balance carrying forward from last year, and you know these transactions that have gone through with this company, and it should ideally tally with the closing balance that the related party being disclosed. Uh, and once it comes to the group scenario, when you're doing the consolidation audits, the group audits, you all know these related parties should tally from receivable to payable transaction, will say sales and cost of sales, because if it is otherwise, the transactions will not ideally be eliminated in the group scenario and remaining balances would be there if the companies do not have real financial discipline or real recording, or it could be due to goods in transit or cash in transit. So even at the group level, this eliminations is critical because what What happens is often the risk that we have seen, we say a company has done a related party transactions with we say company A and B, the same example. Company A has done a revenue transaction with company B. Company A has sold to company B. The company A has recorded this revenue in the individual financial statements, and in the company B, they have recorded, as a purchase and then to the cost of sales, this transaction. So at the consolidation, ideally this revenue and the cost of sales should get eliminated, because if you think as a group, there is no transaction. It's within the same group. So, but if these transactions are not properly identified and captured, what happens is group revenue is, if it is not eliminated properly, the group revenue is overstated, group cost of sales is overstated. No impact to the profit unless from the unrealized profit element, but consolidation picture is wrong. So that often happens because the companies are not keeping the track of these related party transactions, and their ERP systems are not really supportive of generating this data. So we need to highlight if you see something like that as a control weakness, because otherwise this consolidated picture will go wrong, which is again financial statement misrepresentation. So I think I covered basically what is required to be done for the related parties. The recap there is you need to identification and the completeness are the two critical elements that you need to be careful. Third thing, you need to be thorough with your accounting standard knowledge, in especially identifying these related parties. Third thing, when we auditing, we need to really substantiate whether it's arm's length or not. You need to check, especially agreements, invoices, contracts, related party transaction minutes or any other board minutes or things like that to substantiate those transactions. And in the console picture, you need to ensure these related party transactions are properly being eliminated. So, once it comes to the directors, key management personnel declarations need to be obtained, or at least you should have some other alternative mechanism to identify these transactions or the equity that they are controlling. Because sometimes, unless you get the declaration, you don't know what their spouses and their equivalents. Because sometimes there are, directors, their spouses are running their own businesses and they are sometimes business tycoons. So just because they are controlling it and there's a spouse to this director, it becomes related party. But there's a high tendency we will, or the company auditors would miss that unless you have those details, right? So getting their those required information is also a critical piece, right? So that's ends the related party session also. Happy to get any questions from related party transactions or even the going concern to that matter. I'll give a couple of minutes. Any questions? Nothing on the chat. I'm sure everyone would be tired. In that case, thank you very much. I'll wind up the session today.
Right. Okay.
Over to you, Natasha. Yes.
Yeah. So, Mr. Damit, thank you very much. On behalf of the Department of Accounting, I would like to express our sincere appreciation for the time and effort you have dedicated to this guest lecture series. So, you have conducted actually 2 guest lectures, one physically, and then today's insightful online session. And we are truly grateful for your continued commitment, sir. And the knowledge and real world perspectives you have shared, particularly as a partner of Ernst & Young, have specifically enriched our students' understanding of auditing in practice. And also, Professor Ajwat, our course coordinator of this course, couldn't be with us today due to personal reasons, but he asked me to convey his warm regards and to thank you immensely on behalf of him as well. So thank you once again for your generous support, and for taking the time to contribute meaningfully to academic program amidst your very busy schedule. And we look forward to collaborating with you again in the future as well. Thank you very much on behalf of the Department of Accounting.
Thank you so much, Natasha, and thank you everyone for listening. Let's meet in a future date. Thank you so
Right.
much.
Thank you very much. Good night, sir.
Good night.